So the Monetary Policy Committee body of the Central Bank today concludes their two-day rate-setting meeting, and their communique is expected within the hour. This is the final meeting of the MPC in the new, and some of the signaling of what lies ahead in 2020 are expected from the briefing that's live from the Central Bank Chief Godwin Emefiele from 2:15 local time. That's just about 35 minutes from now. Of course, you've seen my panelists introduced already, but let's give you a bit of a background to the road we've traveled since 2019 started as far as the MPC and the monetary policy decisions are. Just a summary of it. It doesn't represent everything, but it gives you some of the highlights of what we want everyone to focus on as we begin this conversation. First, we had our monetary policy rate cut to 13.5%. That was on March the 26th from 14%. That's for the first time in about 3 years. The idea and what the central bank governor says on March 26th this year was that the rate cut was to spur economic growth. Of course, we're coming from a 14% MPR environment since July 2016. The idea then was to tame inflation, back the naira, support the naira at the marketplace. Then we have the central bank forecasting inflation of 12% for the 2019 as at October. The number we had this week was, or last week was 11.61%. What has happened? Then the central bank moved in with what you call a raft of monetary policy tools to ease bank credit for consumers, for SMEs, then use the FX reserves to defend the naira. That is now around $8 billion by some estimates. Then you have the rapid intervention since the start of the new year by the central bank in the palm oil business, in textiles manufacturing, in arts and entertainment, everything, road, everything, the entire brick and mortar. Now the central bank has its neck deep in all of that. Then you had what came in around August, September, now October, now November. That's the rejigging of the treasuries market, kicking Nigeria's treasury bills yield curve into single digits. So let's start this conversation with the gentleman here before thank you, gentlemen, for coming. We appreciate your time.
Thank you, boss.
Let me start from the far left of the table. So, Mustafa, let's give us your sense of where we are in terms of the monetary policy footprints since 2019 started.
In March, CBN sort of sprang a dovish surprise by cutting rate by 50 bips. And basically, as you said clearly earlier, it was perhaps to sort of support economic growth that's been really tame in recent times. And since then, they've held policy rates at 13.5% levels. At the start of Q4, our worry for CBN was how they were going to, tackle this impending system liquidity, which we estimated then at around 4.2 trillion.
You were talking about the March 26 MPC meeting, 50 basis point cut to 13.5%. Right. Was that a turning point or the high point of this year MPCs for you?
Certainly, yes. I mean, it's very clear when we started in Q4. Maturity was huge. If you go by history, what we typically see from CBN is when they are facing this kind of elevated maturity, you will see them aggressively going to mop up those liquidity in the system and also jack up average almost stop rates, right? But I mean, what they did, which is quite surprising for us and for many other houses, because perhaps it's almost unlikely that anyone saw it coming. The CBN banned individuals and non-bank corporates from participating in OMO, which we estimated at around 27% of the entire maturities in Q4, right? But to make foreign investors happy and also banks, the CBN actually jacked up rates by about 6 bips in October. Then also, because of that bullish run from a lot of maturities from individuals and non-bank corporates, T-bills yield actually crashed by about 10 basis points in October before swinging into negative territory.
So Wale, do you think that March 26 surprising 50 basis point cut, was that a mistake? Was it, looking back now, it looks like something somewhere happened in the middle of everything. Now it looks like, do you think the central bank has since retraced that 50 basis point? Did it really work?
I mean, I don't think it's a mistake, because if you look back, it looks like from that point on, what we've been seeing is a series of dramatic announcements from the CBN. I'm not sure whether the conversation is whether it worked now or not. But the CBN at that point was very particular about, from now on, we want to, stimulate growth. And to achieve that, what we want to do is to drive real sector credit. And from then on, what we continue to see are policies that are completely unconventional. They started tackling banking sector lending, limits what banks will give out in terms of loan to deposit rate to 60%, when they observe that, that was working from about 15 trillion to 16 trillion as at the end of September. They simply shift the goalposts and say, okay, you guys do 65% minimum by December. And then, when, just like Wahab was saying, we were wondering what they are going to do to the close to 4 trillion naira liquidity that was expected to mature. In my opinion, what they simply did was to, come to a gun battle with a bazooka, and decide not to, sell or roll over almost to non-banks as well as, other corporates, leaving out only FPIs and banks. What we've seen now is money market rate crashing to single digits, and the spread between NTB rates and OMO rates that you are selling to banks and FPIs is about 8%, 5% spread from 8 to 13. That's a lot of spread. So, Q3 GDP number showed some level of improvement in GDP number, but the growth we are seeing clearly suggests that it doesn't look like monetary policy have the capacity to achieve what the CBN really want to achieve. You need fiscal policy to support the kind of growth, because what we are seeing is the fact that growth remains locked between 2% range, and banking sector credit or banking sector asset quality that seems to be improving may be a risk factor going forward if banks begin to aggressively deploy loan to the real sector in the absence of ease.
Both to consumers and real sector.
Exactly, in the absence of ease in the business environment.
Abiodun, do you think that the inflation, one of the things the central bank seems to got very correctly was forecasting inflation uptrend for the rest of the year. We saw that between March and July meetings, and the central bank, the MPC, actually said they forecast that. So forecast 12%, we're now 11.61%. So that looks like that trajectory is there. Some analysts says we're heading to 12, maybe between now and Q1 2020. So if you look at this macroeconomic indices, and of course, if you put in your capital importation numbers and what have you, that growth target, do you think the central bank has done enough, or has it done all that it could? Now we're left with the fiscal authorities.
So the central bank really had a lot to do, basically. So, the rate cut in March, comes from the backdrop of the election we had in February. And the focus then was how to stimulate growth. So that's why they had to, part of the reasons they had to cut interest rate. And afterward, inflation was a little bit on the low side, so which was also supportive of a lower interest rate environment. Now, speaking to your question, I would say the central bank has been doing a whole lot in recent months, which is all geared towards stimulating growth, vis-a-vis, also ensuring that they protect the external reserve from the perspective of foreign portfolio investment, albeit looking at the capital importation numbers, that indicator is not really picking up. The Q3 capital importation number, if you look at the foreign portfolio investment side of it, it declined by about 30% quarter-on-quarter. The key driver, which is money market instrument, also, even though it contributed by 80% to that basket.
Translating an outflow or just a net inflow, which is lower? Net inflow. Did we see outflow as well, based on any of this monetary policy circularizing scenarios?
Sure, definitely. There were outflows, but on the net of it, I think we had a little bit more inflows, which is why it declined on a quarter-on-quarter basis.
Well, let's squeeze in a bit more of macroeconomic, because I'm interested in, Mustafa, we came in with a new cabinet. Folks says, well, perhaps, maybe this team is a little bit better than the first term of Mr. President in 2015. But again, if you look at what our capital spending has been so far, just about 650 billion. The Minister of Finance says that will be ramped up to 900 billion by December, at least by December the 31st. Are we encouraged by this fiscal spending so far to stimulate the economy on the fiscal side? The central bank keep rejigging the monetary tools to try and simulate credit to the consumers and the SMEs and the big corporate, if any one of them want to do business in palm oil, want to do agriculture, want to do palm oil, want to do textile, and all of that?
I mean, I sort of understand the position of the CBN, and it's clear that the fiscal side is sort of incapacitated when you look at it from the perspective of revenues generation of the FGN. I mean, revenues, collected revenues has actually been really abysmal in recent times. I mean, the last time we checked, we actually saw that oil earnings for Nigeria is actually not even enough to fund recurrent spending, not talk of capex implementation. So it's very I mean they are not in the position to actually drive economic growth right now. I think that's one of the key reasons why we're seeing a lot of activities from the CBN to sort of support that side, where things are not coming from the fiscal side. CBN should aggressively drive down borrowing costs and also push a lot of credit to the private sector, such that a lot of business are able to fund their borrowings, expand their businesses, and also employ Nigerians. So that's why we're not seeing activities from the FGN side because of revenues pressure, right? So I mean, going forward, I mean, GDP is still going to continue to remain largely low at perhaps 2% levels. And when you compare that to population growth rate of 3%, you'll see that per capita income is actually negative at that current level. So it's not really encouraging.
Okay, great one. Gentlemen, you need to stand by. We're getting to the meat of it. We're expecting the central bank governor's briefing within the next 20 minutes, so we need to wrap this up. Stand by, everyone. We thank you very much for watching this special edition of Business Incorporated. We're right back for the central bank governor's briefing. It's going to be a little bit lengthy, so you need to be prepared. It's the final one for the year. It's a look back and a look forward briefing. So everyone, stand by. Thank you very much for watching.